Somewhere between 2011 and 2016, millions of Wells Fargo customers had an account they never opened, a savings account, a credit card, an online banking enrollment, sometimes a debit card mailed to their address, all created without their knowledge. Some found out only when a fee showed up on a statement for an account they didn't know existed, if they found out at all. Since bank employees sometimes listed their own contact information on the paperwork instead of the customer's, so no statement or survey ever reached the person whose name was on the account. In September 2016, regulators announced that Wells Fargo employees had opened more than 2 million deposit and credit card accounts that customers never authorized, a figure the bank's own later review would revise upward to roughly 3.5 million. By the time the number was finalized, the bank had fired roughly 5,300 employees over it. Unlike the other cases this channel has covered, this one had a board of directors, a compliance department, and an internal ethics hotline. All three existed. None of them stopped it for years. Wells Fargo built its identity around cross-selling, the strategy of getting each customer to hold as many bank products as possible, on the theory that a customer with a checking account, a savings account, a credit card, and a mortgage all at the same bank was a customer who would never leave. Under Chief Executive John Stumpf, the internal slogan for this strategy was, 8 is great, a target of 8 separate accounts per customer, up from an industry average closer to 6. Branch employees were expected to open roughly 8 new accounts a day, with daily sales reports sent up the chain and compensation, schedules, and continued employment tied directly to hitting that number. Managers who missed quota faced discipline themselves, which meant the pressure did not stay contained to any one level of the company. For thousands of employees, the math simply didn't work. There were not enough customers who wanted 8 products, so employees began manufacturing the difference instead. According to the federal consent order that later resolved the matter, employees opened unauthorized deposit accounts and transferred money into them from customers' real accounts without permission, sometimes shifting small amounts back and forth to make a new account look active enough to count toward quota before quietly closing it. They submitted credit card applications in customers' names, using information the bank already had on file, without asking. They enrolled customers in online banking services they never requested using invented PINs, and ordered debit cards customers never asked for. Signatures were forged. On a significant number of these accounts, employees listed a Wells Fargo email address, a generic phone number, or an employee's own home address instead of the customer's real contact information, so the customer never received a statement or a satisfaction survey that might have exposed what had happened. Customers who kept too little money in their real account to cover the phantom transfers were sometimes charged overdraft or insufficient funds fees on money they never agreed to move in the first place. Federal prosecutors later stated that senior managers within the community bank division itself were aware of sales practice misconduct as early as 2002, more than a decade before the practice actually stopped. In 2013, a Los Angeles Times investigation exposed the sales pressure inside Wells Fargo branches, reporting that quotas had become so aggressive that some employees described them as mathematically impossible to hit through legitimate sales alone. The bank's public response at the time was that its internal controls were sound and that any misconduct was the work of a small number of bad employees, not the incentive structure itself. Employees who tried to raise concerns through the bank's own ethics hotline were, in multiple documented cases, fired shortly afterward. One branch manager was terminated 3 weeks after calling the hotline. Another employee was fired 8 days after reporting the practice over an unrelated attendance issue raised for the first time right after his call. A former Wells Fargo human resources official later described a deliberate pattern of finding a pretextual reason to remove employees who had reported problems rather than investigating what they reported. The channel the bank pointed to as proof its controls worked became, for the people who actually used it, a way to get identified and removed. In September 2016, the Consumer Financial Protection Bureau, the Office of the Comptroller of the Currency, and the City of Los Angeles jointly fined Wells Fargo $185 million. The CFPB's $100 million share of that figure was, at the time, the largest civil penalty the young agency had ever imposed on any company. Stumpf testified before the Senate Banking Committee that same month, where Senator Elizabeth Warren told him directly that he should resign and be criminally investigated, calling his response to the scandal gutless leadership for pushing accountability onto low-level employees, while he himself, in her words, walked away rich. Stumpf resigned within weeks, initially set to leave with a retirement package worth more than $130 million in accumulated pay and stock. The following April, an independent board investigation found he had been too slow to challenge the sales model, and that Carrie Tolstedt, who ran the division responsible for the quotas, had resisted changing it even as the scale of the problem became clear internally. The board clawed back more than $180 million in executive compensation altogether across multiple actions, $69 million from Stumpf and $67 million from Tolstedt, cutting deep into the payout that had briefly made his departure look consequence-free. In January 2020, the Office of the Comptroller of the Currency banned Stumpf from the banking industry for life and fined him $17.5 million in a civil settlement over the sales practices themselves. The following month, in February 2020, Wells Fargo agreed to pay $3 billion to resolve criminal and civil charges with the Department of Justice and the Securities and Exchange Commission, acknowledging in an accompanying statement of facts that the misconduct had continued for years after it was first known internally. No senior executive was criminally charged at that time. Tolstedt became the only Wells Fargo executive charged criminally, pleading guilty in 2023 to obstructing a bank regulator's examination, a narrower charge than the underlying account fraud itself. She was sentenced to probation and 6 months of home confinement, not prison. A growth restriction regulators placed on the bank in 2018 as part of the cleanup wasn't fully lifted until 2025, nearly a decade after the scandal first became public. Every safeguard this case needed already existed on paper. A board, a compliance office, an ethics hotline built specifically so employees could report exactly this kind of problem. The failure wasn't an absent structure. It was a sales culture allowed to override that structure for more than 10 years. A warning sitting in leadership's own internal data since 2002, and a reporting channel that punished the people who tried to use it as designed instead of the practice it was supposed to catch. A control nobody protects is not meaningfully different from a control that was never built, and a bank that took nearly a decade to fully exit federal oversight learned that the hard way.